Atlantic Asset Management was established in 2007 as a dedicated fixed income asset management house. The group offers funds that focus on capital preservation and income generation. Atlantic has 3 collective investment funds. I'm joined now by Arno Lawrenz. He's Chief Investment Officer at Atlantic Asset Management. Arno, thanks very much for joining us this evening. Let's have a look at what people should be doing with their money in a low yield, low interest rate environment. Perhaps you can kick off there.
Okay, so I suppose the easy answer, Bronwyn, tonight is in the low yield world is number 1 rule, stay away from cash. It might sound like a bit of a contradiction in a way in a turmoil-filled world to stay away from cash, which people tend to say cash is king. But the one point I'll leave investors with is that if you're leaving your money in cash, currently your best rates that you're earning are probably sitting in the region of about 5.3% for institutional investors, never mind the man and woman in the street. But where is inflation? It's at 6%, so you're actually going backwards. That's the first rule.
You're going backwards, that's the first rule. You've got to accept it. What can you do to help yourself out of the situation?
Look, I think the first thing is that in order to move away from cash, one must accept that you've got to take on a different approach. And I think this is the theme and message that we've been taking across the country over the last month, is that you need to change your approach in times like this, because these are times that are not comparable to anything within the last 20 or even 30 years for that matter. We actually have the belief that this is a 70 or 80 year cycle. It's the end of a leveraging phase rather than just a normal business cycle. That means if you're an income investor, you must be prepared to look elsewhere. And that includes things like listed property, pref shares, credit, and even going into the dividend space as far as income is concerned.
Oh no, just with listed property there, we're on a deflation, a deleveraging cycle if that's what's to come. Do you think there's capital risk on listed property at the moment?
Without a doubt there is. I mean, one of the key inputs in terms of valuing the cash flows that come out of listed property is, of course, bond yields. And generally people will look at, say, for example, the 10-year bond yield, the 5-year bond yield. And there's always risk that in times like this, in a South African context at the very least, where you have these risk-on, risk-off episodes. In the risk-off episodes, where, for example, the rand may blow out a little bit, bond yields kick up 50, or even we've had in the last 4 odd years, even 100 basis point kick up. It makes a substantial difference to your valuation of the property cash flows, which means, of course, that if you're sitting in property, in the long term, yes, your underlying rentals are pretty secure. But on a mark-to-market basis, you definitely are still subject to that capital volatility.
Arno, you also mentioned in this environment that you need to look with a longer-term time horizon and then also look to geographically diversify. Can you just talk around those 2 issues as well?
Sure, definitely. I think the long-term time horizon, there's a couple of issues here. It's not just about saying, well, I'm going to ride this out, close my eyes, sort of ostrich head in the sand type strategy here. It's a very particular strategy based on saying, what am I trying to achieve, and knowing what that objective is, and then sticking to it. It's no use chopping and changing depending on what's going on in the world. You must know what you want to be able to achieve. That's the first part about the long-term horizon. The second one is an acknowledgement of the fact that there is longevity risk. So people who are thinking about retirement, working towards it, getting to age 65, whatever the case might be, and then in their minds thinking about an investment strategy post-retirement, which perhaps is only 15 years. What happens if you live for 20 years or 25 years? Does your investment strategy hold out for that? Do you stress test it? So there are the longevity risks. As far as the geographical issues are concerned, the one thing about income that we need to be cognizant of in a global context, very much similar to if one thinks about what happened in Japan, and I've been saying that Japan is the template that we must use. What did the Japanese do? Even the man in the street, the retail investor in Japan, is buying exposure into, for example, South African rand government bonds. Just think about that carefully. Japanese investors buying South African government bonds. Why is that? It's a very critical question. If you go and look at what bond yields are in Japan, 10-year bond yields, 1%. And it's been there between 1 and 2% for the last 13, 14, 15 years. In the South African context, we're at a low point. So we're getting 5.3% on cash. Our 10-year bond yields are also fairly low by historical standards. What do? Eventually you start saying, hang on, I wanted 10, I need 10. Where do I go to get it? Japanese come to South Africa for higher yields. Where do we go to? So we've got to look beyond our borders as well. And it's not about going into Greece. I've got a long-standing story with Bronwyn about Greece, and I still don't think it's a good investment destination.
Remind us of that long-standing story about Greece. Arno, come on, shed a little light on your thoughts on that front. I want to take you back there.
All right. This goes back at least a year, which is that the writing was effectively on the wall as far as Greece was concerned in terms of a default. And what we saw happen within the last couple of months, where a write-down of the values, they're taking a default effectively, is what has happened, a credit event. Now, why did I say the writing was on the wall? Well, there's three choices for someone, whether it's a country or a sovereign, as far as being over-indebted is concerned. One, you can default, which we know Greece eventually did. But let's perhaps look at some of the other issues. They could print money. Well, Greece didn't have that option because they're part of the Eurozone. It's not their responsibility to print the currency, so that option was out for them. The other side, of course, was for them to perhaps cut back on debt. Now, the problem for them in terms of austerity was if they cut back and went into austerity, which is what they tried, it just created an imploding economy, which just exacerbated the debt to GDP ratio. So the writing was on the wall. They just were in a hopeless situation. Now, they're not the only ones. There's still more to come. So, Bronwyn, there's going to be another story coming forward over time, I think, and I'll whisper some of the names like Spain in particular, and Portugal, and even some of peripheral Europe like Hungary, just to whet your appetite for some future shows.
Can't wait to have those discussions with you. Kevin's appetite has been whetted at this stage.
Well, I fully agree with your comments on Greece, and obviously there's some other beacons over there which you need to be aware of. But is there any area in Europe where you are prepared to put money?
I would only consider the currency, strangely enough, because I think there's so much vested interest in keeping the euro intact, in a sense. So yes, we might find, due to the pressures, that a Greece or a Spain might eventually capitulate and perhaps leave. But the euro itself, I still believe there's so much bad news surrounding it that on let's call it a short-term basis of over a year or so, I would put it past the Germans to in fact engineer some sort of currency strength at some point in time in order to counteract all of this negativity that's going on.
Now, let's bring in another theme here. In this search for yield, there is a big focus on dividends at the moment, on dividend players, and obviously dividends being generated from equities. That's where I'm going. This is a theme that also I've seen in your presentation, Arno. Is it something that everybody is catching on to at the moment?
Yeah, I think it's become quite a global story. What you're seeing within the US in particular is a diversification away from US-centric dividends into, in particular as an investment strategy, into emerging market dividends. Now, obviously, South Africa is a beneficiary of that sort of strategy. Even within South Africa, you can go and do an analysis of the JSE at the moment and looking at prospective dividends over the next 12 months, for example. And that's readily available, whether it's on Bloomberg or iNet or Timbuk1, any of those systems. And you can go and analyze which companies over the next 12 months are delivering dividends well in excess of what your cash yields are. Even at a minimum, your cash yields as an income investor, 5.3% institutional call rates, there are at least 10 to 15 companies within the main board of the JSE, which are delivering prospective dividend yields in excess of 6.5%. And if you're an equity bull, you're getting that dividend yield plus perhaps even some upside as well. So depending on your views on the equity space, you can either look at it purely from the dividend yield perspective, or you can couple it with an investment exposure into the equity market itself as well.
Oh, no, I tend to agree with you on that. With corporate balance sheets globally are actually in a very strong position, and there's a lot of uncertainty and a lack of confidence is what it's called. And so they're not prepared to invest and hire. Instead, they're prepared to perhaps let some of that cash that they're sitting on go to shareholders, which is creating a good opportunity for people who are looking for some yield.
Inflation-linked bonds,
Exactly right.
Arno, if you're looking at
Yes.
diversifying your portfolio. Now, we know that inflation-linked bonds have performed very well for the likes of the Government Employees Pension Fund, which are big believers in the asset class. What are your thoughts?
Yeah, look, make no mistake, inflation-linked bonds are a fantastic diversifier within the income space as far as moving away from either purely cash money market and investment into nominal yield bonds and credit as well. In fact, on the inflation-linked space, increasingly what we are starting to see is corporates issuing inflation-linked bonds, and that makes an even higher real yield that's attainable for investors, basically. But I really believe that it should form a strategic part of investors' funds. However, I will say this thing, is that any asset, whether you can take any of the top-notch blue chip companies on the JSE, and they remain good companies, but valuations are important. So in the same way as a Billiton or an Anglo's may well be fantastic companies, inflation-linked bonds, while they remain good instruments to use within an income portfolio, be careful of the price you're paying in order to get that exposure. And in particular, I think at the moment where we are at or near the top of the inflation cycle, where those inflation fears are at their worst, where people are saying we want this protection against inflation uncertainty, and you're already at the top of the inflation cycle. So your returns going forward probably be declining from this point onwards.
In other words, it's
Unless,
too
of
late.
course,
What
you
you're
have
saying
someone
is
like the GPF.
What you're saying right now, it's too late to get into inflation-linked bonds. Is that correct?
It depends. If you have nothing, if you have no exposure, then perhaps depending on what your other exposures are, you can allocate some to there. But I do think that you've got to be very, very careful at this particular point in time.
We also need to bring into this discussion preference shares in the search for yield and, of course, this diversification of portfolios. Are you a believer in preference shares?
Absolutely. I think they serve a fantastic component of an income investor's portfolio. Again, in particular where it's a dividend that's being paid. Generally, we only looked at the ones which are linked to prime as well. And the dividend, those prospective income yields that you're getting out of those pref shares are in fact very attractive, again, against the cash and money market type yields, where you're looking at between 5.3 to, let's call it 6.5 at best in the money market space. You're looking at, in the case of the corporate pref shares, anywhere north of 7% up to somewhere just below 8% over the next 12 months. The key, though, of course, is always the liquidity, and therein lies the devil is in that detail, because when you do want to get out of them, when those things are repriced, very, very difficult if you have large exposures.
Arno, just with the change in tax legislation on dividends, did that alter your view on preference shares or merely the way that you value them?
No, I think at the end of the day, it's about evaluation. So the man in the street doesn't really see too much change. A lot of the corporates, especially the ones linked to prime, have already announced that they will adjust that level of prime that they pay out to make out for the change in the dividend withholding tax. So the additional 5% that versus STC. So net, the man in the street or the investor looking at the pref shares is no worse off effectively.